Hello, everybody. Welcome to this month's edition of Capital Markets View. We are going to try and keep it shorter than normal this time, so we're trying to make it a little bit speedier. And if you want to hear about my tulips, you'll have to wait to the end. So, hello, Taron. How are you?
I'm good, Chris. Ready to speak faster.
And talk tulips. Right. So let's dive into our first slide with information on, which is European leveraged finance volume. So if you compare, obviously, this year with the sad events of last year, so we're on 47 billion for institutional this year, which is good. 51, 52 last year. 2019, 70 billion. So actually, this year, considering we're kind of we're recording in mid-May, doing pretty good. I mean, what do you think?
Yeah, I mean, I think we're almost double where we were this time last year. Of course, we have to remember that we had a huge market sell-off and hiatus after the pandemic hit in March. So it's not quite fair to compare like for like, but I think that the market's recovered. And I think, it is interesting looking back when we were talking about 2017 and how high that year was in terms of, why was that year so high? And I actually looked back, and it really was because of the fact that the cost of funding had plummeted in sort of over the course of 2017. It was a record year since 2007. And what was interesting, though, is it really was all sort of opportunistically driven. So as rates went lower, and that was because the ECB really launched it's a CSPP, the corporate bond purchasing program. They launched that in mid 2016. And so that was continuing their quantitative easing program, which in turn increased demand for lower rated, higher yielding assets. So the leverage loan market really, and high yield bonds was busy as well, but leverage loans really took off. I think a lot of demand coming from Asia as well, because the BOJ, also Bank of Japan, also they went negative with their rates in 2016. Mm-hmm. So we can see kind of why that year was so high. We are seeing, though, lots of buyouts in Europe this year. So it's not. There is a lot of opportunistic activity, but we are also seeing buyouts. So there is a good mix of funding so far this year.
So it'll be interesting to see when we get to the very end of the year if the 2021 bar is anything like the 2017 bar. And that explanation was great because you know what? If you take out this year, for example, I mean, 2017 to 2020, all things being equal with 2020, I mean, it looks like a gradual decline in the market. And you and I talked about, is direct lending perhaps sucking out of the public markets? And that's part of the reason why this is going down. And I'm hearing a lot more noise in the background now about direct lending. But perhaps it was just 2017 was an amazing year. And if we're lucky, 2021 will be an amazing year as well.
Yeah, I mean, there is lots of direct lending activity. Actually, we did publish something on that this past week. But I'm not sure that it could fully account for this.
Yeah. Right, let's go on to the third slide, second one with information on average debt size, both in America and here, which shows average debt size up. So bigger deals, basically.
Mm-hmm. Yeah, we've seen an uptick in cross-border activities, increase in deal size. What is interesting and what this chart shows is that we've seen a larger number of big transactions as opposed to a handful of those super jumbo transactions that we sort of saw in the last cycle. So there's just evidence of sort of large, and this is both U.S. and Europe combined, bond and or loans. So this is the real global picture.
The whole market, everything.
Yeah, and as I was saying, we've seen an uptick in buyouts globally. Year to date, 25% of all issuance for this on the loan side comes from buyouts, and that's up from 17% last year.
I must admit, I get the alerts, pinging into my inbox from LCD, and as the headlines come in, I'm noticing, more and more of them. It's like around $1 billion, like you said, a stream of not jumbo, but kind of chunky deals that seem to be happening.
Yeah.
Cool. Okay. Next slide. Slide 4. Whoa! Yay! It's the flex slide.
You always like
um,
this one.
yeah. No, I like this slide because it kind of really it's instant the way it is. But so given the fact that the red bar is shrinking, so less flax is down, and the blue bar's up a bit. I mean, only a little bit.
Yeah.
Perhaps we're beginning to see the market stabilizing in terms of pricing.
Yeah, this shows rolling 3 months. So I looked at the monthly numbers, and when you look at March, it had two flexes up in Europe, and down was 20. And in April, again, two flexes up. So it hasn't gone up, as you correctly stated, but only 11 down. So we are seeing fewer downward flexes. I wouldn't say the market's backing up entirely. Like you said, it is just probably stabilizing a little bit. We went a little too far the other direction. Pricing as well has come back up, spreads and yields. I think that's our next slide.
Yeah, okay, so let's go to the next slide, which is average B-rated euro-denominated term loan B spreads and yield to maturity. So yeah, there's a little kind of kick up at the end of the graph.
Yeah, and actually, because we were just talking about sort of 2017, 2007 as well. I looked, and actually, that end of 2017 was the post global financial crisis record low in terms of pricing, and you can actually see that on the graph. You can see how low it was. So it was 336 or 337 basis points and 3.56% yields. And now in April, we ended at 3.84 and 4%. So, the closest that we got to beating that record was back in the first quarter of last year, but we're not back to that point yet. So even though things have ticked up a bit, we're still not anywhere near the record lows or even first quarter 2020.
See, and you know what? You and I will both keep a very close eye on this because I must admit my prediction was that things would just keep on ticking down, but perhaps that was wrong, and perhaps the market has stabilized a bit. Okay, and okay. Let's have a look at slide monthly CLO issuance. And my goodness gracious, of course, the story here is resets and refis. Interestingly, we're only halfway through May when we're recording. I must admit, I've noticed a slowdown in CLO issuance, but that refi reset story for February, March, April, just huge.
Yeah, there are a lot of warehouses, though, as we were discussing earlier this week. About 50 we're hearing, but maybe
at
higher.
At least.
Maybe 55. So,
that compares pretty favorably to the warehouses in 2019. So perhaps another really, really good year for CLOs.
Mm-hmm.
I think it depends on whether the arranging teams can spend more time on new issuance rather than resets and refis. And we did some estimates, actually, of how many resets and refis are coming up, and they're a lot. I mean, because there's the ones that naturally do this year. There's the ones that should have come last year. There's the ones that are coming from the past. I mean, there's a lot of things that are going to reset and refi this year. The arranging teams and the agencies are going to be very busy.
Yes, and that's because of pricing going down, which is our next slide.
Well, and you know what? Interestingly, if CLO pricing carries on going down and loan pricing goes up, that's great. For them, the ARB is really good. And I must admit, this slide to me shows AAA's, flattening, but it's not the whole story. Of course, there's the weighted average cost of capital as well.
Yes, and actually, when you talk about the ARB, what's interesting is that the weighted average cost of capital has come down from the fourth quarter of 2020. It was 200.71, so let's call it 201. And then the first quarter of this year was 167. So that's come in quite a bit. Also, of course, the single Bs have also come in, the margins. But if you look at the difference, the arbitrage has gotten slightly better first quarter. So we've gone from the difference between them of 211 at the end of the fourth quarter, and it's increased to 216 at the end of the first quarter.
So, and of course, that must be driven by more competition for single Bs, double Bs, other parts of the stack, which puts the weighted average cost of capital down, which means the ARB is slightly up. So good news if you're a CLO investor in terms of the equity, and if you're a CLO manager putting things together.
Yeah, and just to remind our listeners, over 200 is where everyone says is the sort of, that's when it's favorable to issue. So yeah. So
they're nicely over that magic number. And last but by no means least, my tulips. So for those of you who watch Gardeners World on the BBC, apparently this is a very slow year and things are opening up 3 or 4 weeks after they should do. So we finally got them.
Is that because it's been so cold, Chris?
Yeah, cold. Yeah. Everything's about a month behind where it should be. It's the first time I've planted tulips. I think they're quite nice, actually. I do say so myself.
They look lovely.
Cute. Right. So I would encourage everybody to watch us and Gardeners World, both very good programs. And thank you for watching if you got this far. And if you have any questions for Taron or me, please feel free to send them over. Thank you.